Welcome to the advanced underwriting video. In this video, I'm going to go through the advanced concepts of underwriting. I'm going to assume that you've already been through the basic underwriting video or you have a pretty solid understanding of how to underwrite a deal. So what I am not going to cover in this video is the basic math formula, the income approach, comparable sale, all that. We've covered that in the other stuff already. So this video, I'm going to be kind of looking at T12, how to read a T12, a profit and loss, how to read a rent roll, and some of the other higher level deal analysis concepts. So getting started, the three basic items that you need when you go out and first get data or you want to first analyze a deal are going to be the rent roll, the trailing 12, and the offering memorandum. All right, so I'll write that up here. That's going to be the T12, okay, the OM, and the rent roll. All right, so the T12 or trailing 12, this is a profit and loss in the month-to-month format. We went over this a little bit in the last analysis video, and I'll cover this a little more in a few slides. But this is a profit and loss in a month-to-month format, extending back from the last month that was closed out in the seller's books. Okay, so a normal profit and loss or a P&L is going to be for 1 year, and it usually runs from January to December. It's going to be that kind of calendar year. A trailing 12 is going to be 12 months of financial data, but extending back from last month back 12 months, regardless of year end. So a profit and loss is going to be probably January to December. T12 is going to be a rolling 12 months. And this can also be called a rolling 12 or a trailing 12. All right, so this is what we're really after. The reason, and I'll show you in a minute why we want to get it in this month-to-month format, is because we're looking for trend data. We want to watch the trends on the property, the revenue up, the revenue down, expenses up, down, things like that. If you just kind of get that one column of data in a profit and loss, we can still analyze the deal mathematically, but you don't see the trends. Is the revenue on the rise? Is it on the fall? What about vacancy? Going up, going down? We don't know when you just have that one column of profit and loss. So that's why I want the month-to-month format. Also recommend that you try and get that in Excel or in some sort of database if you can help it. If you get your financials in PDF, it makes it a lot more difficult to sort of analyze a deal. You can't copy and paste so well. You can't change formulas and things. So just a tip, try and get that in Excel. The OM, or the offering memorandum, this is going to be the property package. This is the charts and the pictures and the graphs and everything that the realtor has put together for you to kind of analyze the deal. Now, one mistake that a lot of people make when they're new is to analyze the T12 that the realtor has put inside of the offering memorandum. Don't do it. We never analyze financial data inside of an OM. If you're a realtor, love you mean it, love all my realtors, but I've seen an awful lot of deals where the financial data that was put inside the OM did not exactly match the profit and loss of the T12 I got from the seller or the property management company. And so sometimes realtors normalize some of this data. And that's fine, but I really kind of want to make sure that I get my data straight from the seller, straight from the property manager. So I only use the offering memorandum as sort of reference only. I'll show you a few things that we do look for in here, comparable data and that sort of thing. But a lot of times you'll find a pro forma in the OM from the realtor. Okay, we can look at that, but again, kind of reference only. We don't want to actually analyze the deal based on that, and never analyze the deal based on the profit and loss information inside the OM, even if the OM says this is actual data. Trust me, don't do it. I've never gone on a property tour where the realtor looked at me and said, "Hey Bill, you should buy this property. It sucks, but you should buy this property." Never had a realtor tell me that. I've never seen an offering memorandum that said, "Hey, this is a horrible deal," right? But I sure have seen some bad deals in my time, and I've seen some deals that really didn't work, but I've never seen a realtor actually say in an OM, "This is a terrible deal," right? So all I'm saying is that the realtor, don't kill the messenger, but the realtor is putting the property's best for their client. They should. That's what I would want a realtor to do for me. So again, you kind of have to understand that the realtor is doing the best they can with what they've been given to sell. Sometimes they've been given to sell a good property. Sometimes they've been given to sell, property that's a bit questionable. Either way, a good realtor is going to do what they can by putting that property in the best light possible. So anyway, there you go. Don't always trust your OMs, but that's kind of a tip there. And then our rent roll, all right, that's going to be the tenant balances and the move in, the move out date, and all the stuff that kind of tells us about the property. I'll cover that in detail in just a second. So again, those are your three things that you're basically after: your T12, your OM, and your rent roll. Are there other items that we could get to analyze the deal? Yes, there are, but tax bills and things of that nature. But again, I think for right now, this is the basics of what you're going to need to make a value assessment of the seller's asking price. And remember, that's what we're always trying to do when we analyze a deal. We're trying to find out, is this price the right price to pay for this property? That's the point of deal analysis. Okay, so moving on, we're going to, all right, let's break open the offering memorandum. Okay, so inside the OM, what we want in here is these two things here, largely. Inside our offering, our OM, you're looking at comp sales and comp rents. This is what we call comp data, right? Comparable data, comparable sales, comparable rents. That's one of the big things that I use the OM for. Now, let me give you a tip. When you're trying to learn a new market, and let's say you've gone into a new area, or maybe this is your area, your own backyard, and you're just getting started, OMs and pulling several different property listings and property packages is one of the best ways to get demographic data in your market without doing too much research. So instead of spending all your time out there going through the census and all these other sites trying to aggregate data, just go find several properties that are for sale in a market, pull those property packages and look at the comparable data in each one of those property packages. Because remember, the realtor is going to be showing the stuff that puts this property in its best light, fine. But if you pull 4 or 5 properties and they're not all from the same realtor, then you're going to start to get overlapping comparable data, and you'll really start to get a good feel for the market. But that's why I say you can't look at just one, because that may be someone who is cherry picking out comparable data, not lying, but only showing you the best of the information in the market. And that's what we have to be a little careful about. And that's what I say, if you pull maybe about 5 different property packages, you'll kind of start to get a good picture of what's going on in the market as far as comparable data. So first off, we want to start with comp sales. Okay, that's looking at what everybody is paying in the market. This would where cap rate would come into play. All right, so we're going to look at cap rate here. Cap rate, that's under your comp sales. Okay, and what we're looking for here is going to be the dollar per door that people have been buying things for. So we're not really worried about the total purchase price. This property sold for $5 million. This property sold for $3 million. That doesn't tell us that much. What we want to know is, what are things trading for in our market per door, per asset class? Okay, I'm going to add that, per class. All right. Now, what I mean by that is, remember, we have A, B, C, and D asset classes. A being brand new, B being relatively new, C being more of your affordable housing workforce, and D being all the way into a high crime, war zone type neighborhood. So what we're looking at under comparable sales, we're looking to see if our cap rate is similar to everyone else's cap rate. Are we overpaying or underpaying based on the market? What are we paying per door? And is that in line with the asset class, right? What are we paying per door for a C-class asset in this neighborhood? What are we paying for a B per door in the neighborhood? So that's what we're kind of looking for there, comparable sales. Distance-wise here, as long as your properties are in the same sort of side of town, or if they're in similar neighborhoods within a city, you're probably okay. So I'm gonna put maybe about a 10-mile radius on properties for comparable sale data. So, if I see that this property the realtor's showing me is in Atlanta, and then I look out and one of the comparable properties is 50 miles away in some other city, I probably won't really look at that data that much. So point being, you want to stay within about 10 miles for comparable sales or so, and you got to make sure that if the neighborhood hasn't changed, that if the property is in a C neighborhood and the comp sales are always over here in some kind of A neighborhood, we have to take that into account and consider that. So again, there's no one answer. We're just going to kind of glean all the data that's inside that property package, use our brain, and pay attention to what's going on to get an understanding of the market. All right, comparable rents is very similar. Here, I'll clear that out. Relatively similar. In comp rents, we're looking at per square foot in this model instead of per door. So we're gonna say rent per foot here, okay, instead of per door. The reason we want to be careful about comparable rents per door per foot here is because units can change in size. And I know we talked about that in our other video where we went through comps and comp data. But basically what I'm saying here is if you have a realtor or someone show you a 2-bedroom, 1-bath unit that's rented out for $800, and they say, look, down the street is another 2-bedroom, 1-bath unit rented out for, say, $1,000, and you're saying, oh gosh, look, my unit is $200 below market. Well, hold on. Is it? Because that other property, the other unit may be larger. And so that's what we have to pay attention to per foot. And if you'll get the rent per square foot, that'll give you a very accurate read as to whether you can be raising rents or not in that particular market, or giving you an estimate of how your rent stacks up to other units. So definitely per foot. In this particular case, you probably don't want to be getting comp rents for more than 3 to 5 miles out. This is going to be sensitive. We talked about this before. This is going to be sensitive based on the amount of population in the area. So the more people that live in a particular area, you're going to want to shrink that distance, right? And go more towards 1 to 3 miles. If you're in an area that is less populated, you can move out a little more towards the 5 mile. But at any rate, this is kind of a 3 to 5 mile radius, looking at comp rents, rent per square foot. You also kind of have to pay attention to age, asset class, make sure that you're looking at everything, apples to apples here. But this is largely what I'm looking for in the offering memorandum, making sure that this is relatively reasonable, and it just helps me get an understanding of the market. So you never buy a property by what's inside the OM. You never live and die by the OM here, but it's really good reference. And again, when you track a market and you stay in an area and you analyze deals on a very regular basis, you're going to get to know your market very well. And it will be very easy for you to just instantly spot something in an OM, or when someone brings you data that doesn't match, it doesn't fit. And you're going, no, I know you're not getting those rents in that market, or I know that property's overpriced in that area. And you'll just learn. You'll kind of figure that out over time. So that's practice in our market. Okay. Now let's talk about the other things we got in the OM here. This is your comp data here: age, size, location, amenities. I know this is going to be a review as we've gone through this in another video. But again, what we're looking for when we're talking about comparable data, these are the 4 things that you have to make sure you pay attention to when analyzing that comp data. We want to make sure that the other properties that the realtor is showing us are similar in age. I'm going to say plus or minus 10 years. All right. Meaning if I'm looking at a property that was built in the year 2000, then I think comparable properties would be from 1990 to 2010, a 10-year over-under from the construction date. All right. Size, I'm going to say plus or minus about 20% in unit count. So we'll say 20% in unit count here. Okay. So if I'm looking at a 100-unit apartment complex, I would say comparable properties would be from about 80 to 120 units or so. If I'm looking at a 40-unit apartment complex and there are comparable properties in there that are 200 units, I'm going to argue that those are not very comparable, and we would want to kind of discount some of that data. So again, make sure that your properties, the comparable properties that you're looking at, are plus or minus about 20 units or so. Best you can do here. Location, again, I'm going to fall back to that 3 to 5 miles in general, kind of just being safe on that side. We know we can go out over the full city if we're talking about sales. You want to tighten it up if you're talking about rent, but we're going to kind of go with about 3 to 5 miles in location. And then amenities, got to be similar. This is a little bit tough here. So we're just looking for like kind or similar amenities. So if my property has a swimming pool, then I want to see that the other properties probably have a swimming pool or something of that nature. If my property is low on amenities, which we find in smaller assets, if I've got a 10-unit apartment complex, my 10 units probably does not have a swimming pool, a business center, a fitness center, the dog park. It's not going to have these amenities. So I wouldn't want to compare my 10-unit apartment complex to the 100-unit apartment complex that's right down the street that has all these amenities, and then say, gosh, my rents are below market. I can probably get the same rent they're getting. Maybe not if you don't have the lifestyle, you're not offering those amenities to your renters that this property is. So again, this is what I said, it's just kind of a like kind or similar. You just got to pay attention to that and see what kind of amenities you have and what does your competition have. All right, so if you pay attention to all that, you should be pretty good. So age, size, location, amenities, those are the biggies. All right, so now let's talk about the rent roll. All right, I'm gonna back up and take a higher level point of view for a second. Let me pause on this. My philosophy personally for analyzing a deal is I don't like doing it. It's boring, and I personally don't really care for analyzing deals. What I really don't like doing is analyzing bad deals, right? What a waste of time. And so what I have learned to do is several philosophies. Number one, I don't want to analyze a deal, right? I'm lazy. I want to go do something else in my afternoon. I certainly don't want to analyze bad deals. Number one. Number two, all deals are bad deals until proven to be good deals through the analysis. All right, so listen, most people go to deal analysis with the concept, this is a great deal. And if I just sit here and stare at it long enough, it'll all become obvious that what a good deal it is, right? If I just move these numbers around long enough, I'll be able to make this thing a good deal eventually. Be careful about that point of view. That's how we pencil whip deals, right? So the safety measure, and I'm not trying to be negative, but the safety measure here is to assume that all deals are bad until proven good. That's how you stay safe. It's not bad, it's not negative, it's just being safe. So with that thought in mind, I am trying to get to the no as quickly as possible, right? I want to kill the deal as quickly as possible. So I start off with the rent roll. And the first thing I'm going to do, and I'll kind of give you the overview, I sit down and read the rent roll, right? And I'll show you that. Then I sit down and read the trailing 12. I'll show you that next. And then I sit down and analyze the deal. And that would be taking the information, putting it into the template, and trying to decide, is this thing a good deal? So my personal order is read the rent roll, read the profit and loss, or the trailing 12, then analyze the deal briefly, and then create a pro forma in that order. So it's rent roll, T12, deal analysis, pro forma in that order. And I'm trying to kill the deal all the way, right? But if I can get all the way to actually doing a full-blown analysis and the deal looks all right, that's when I say, okay, now let's create the pro forma. Let's sit down and say, what if it does this? What if we change that? I don't want to go trying to create pro formas and spend all afternoon pushing numbers around just to find out that the deal was never going to work in the first place because none of the tenants are paying the rent, or something that we could have picked up a little more early on in our deal analysis. So the goal here is to kind of speed you up. I've said before that you're going to close about 1 in every 80 deals that you analyze. That's been my experience, and that's what I call the race to 80. So what I'm trying to do here is to speed you up on your race to 80 by streamlining your deal analysis and cutting away some of the ancillary concepts. Okay, so starting off, we get our rent roll. We open the rent roll. Number one thing that I want to do right out of the gate is to see, does the tenant balance column exist? Is it there or not? All right. The tenant balance column is almost always the furthest column to the right on a rent roll, number one. Number two, the tenant balance column shows us the balances that the tenants have, be they positive or negative balances, right? I want to know. So keep in mind that the tenant balance column is a debit column by nature. Therefore, negatives are positive and positives are negative. Meaning, if a tenant has a positive balance, that's bad, that's negative, because that means they owe that money. If we see a tenant that has a negative amount of money over here, that's good, because that means they've actually prepaid the rent, right? So we do not want to see positive balances. Negative balances are good, right? Negative's fine, positive, bad. And that's what I said, because the balance column is a debit to begin with. Anything positive in there automatically means they owe that money. So step number one, I'm looking to see, does this even exist? Did the realtor or the landlord or whomever put the data in here or delete it? Now, let me give you a little tip. Almost all rent rolls, when produced from property management software, like, right, I'm running some kind of property management software and I go in there and I hit the print rent roll button. The majority of the time, that template inside of that property management software is going to include the tenant balance. So if I get a property package or I get financials from a realtor and there is no tenant balance, first off, I get a little suspicious right out of the gate. Why is it not there? Right? It has been my experience that in real estate, no news is bad news. Okay? So if there is no data there, my mind immediately goes suspicious and I think, well, it's not there and it must be bad data. That's why it's not there. So number one, I notice that it's not there. And number two, now I'm already getting suspicious because it's not there. And now I really want to see that data, right? Because if it is good information, most people lead out with good data, right? Why hide good data? That's kind of my general philosophy. Now, it's not always true. Sometimes they just didn't put it on there. They ran the template wrong or whatever the case, but that's just a general rule of thumb. Step one, does the tenant balance column exist or not? If the answer is no, the data is not there, then we know we have to go over and request that from the realtor. And what we're looking for is an accounts receivables report. Accounts receivables, all right, meaning who owes us money. So if it's not on the rent roll, now we got to go ask the seller or the realtor directly. But let's assume that it is on the rent roll. Great. What I'm looking for is positive balances. I don't care about the total, right? Now down at the bottom, there will be a total, but I don't really care because it's adding up all of the positives and negatives. So you can have a bunch of people that owe a lot of money and a few people prepay their rent, and all of a sudden down here you get a number that's like zero. So that's what I said, the total is kind of irrelevant. And I don't even really care about the people that prepaid rent. That means I owe them rent, so I'm not worried about that. All I'm after are the people that have positive balances. Okay, if I see too many positive balances, I may decline to analyze that deal any further. This has been a really important concept through and post-COVID, where we went through the eviction lockdown and a lot of people were not paying their rent. But the lenders did not give us a break on the numbers. The lenders still said, hey, collect the rent or you're not getting a loan. So there was no break on that part, right? So that's why I say we saw a lot of high balances through the COVID pandemic. Now, what I'm really looking for is to find out who owes 2 times the monthly rent. Okay, that's going to be this column here, the rent. And so we'll talk about that. This is going to be whatever the rent charge is per tenant per month. Okay, what I'm looking for, does anyone have a balance that is 2x this number here, right? So it has been my experience in management and as a manager and an owner that anybody that hits a 60-day balance or at least 2 months of unpaid rent is more than likely an eviction, a skip, or you're going to have to remove the tenant in some manner. It is low probability that the tenant catches up after about 60 days. I'm not saying zero, I'm just saying low, been my experience. So that's what I'm really looking for here in the tenant balance column, is anybody that's hit a 2x on the rent from here, that's an empty unit. Now keep in mind, what we're talking about here is economic vacancy, not physical vacancy. And this is where you have to be careful, because a realtor or a seller may say to you, hey, look, we're 95% occupied, physically or economically. Because I don't really care that much about physical occupancy. I want to know that the people that are physically there are actually paying the rent. All right? If they're actually paying the rent and they're living there, great. If they're living in there and not paying the rent, that is actually worse than a vacant unit. Because if the unit was vacant, you could just get it ready and lease it up. If someone's living in there and not paying the rent, they're still consuming the unit, they're still creating wear and tear, they're still using the water and the electricity and the utilities. So it's actually a greater negative to have a tenant in place that is not paying. So that's kind of my quick run on the tenant balance column. I'm just kind of scanning through it, adding up how many people have high balances. Okay, great. So if that passes, then I'm going to move on to the move in and move out columns. All right, what we're going to see here is this is going to be, it's going to say lease start, lease in, move out, something like that. You kind of get the idea. The lease, the beginning of the lease and the end of the lease, or the beginning of the tenancy and the end of the tenancy. That's what I want to know. All right, first thing I'm going to look at is the move out column. When do these people all move out, or when does their lease come due? When does it end? What I'm looking for here is to see if I see any one month with a high concentration of move outs. Is there any one particular month that has a whole lot of leases coming due all in that month? That is what we call lease exposure. Okay, and so what I'm looking for here is lease exposure, because your lender is not going to like that, and it can expose you to a lot of vacancy all in 1 month. I'm not saying it's a deal killer. I'm just saying it's something I want to know and I want to read, and so I'm just going to kind of read that. Do I see any big concentration of move-outs? Okay, now I'm going to look over here in the move in column, and I'm looking for the exact same pattern. All right, what I'm looking for in the move in column is, do I see a big cluster of move-ins in 1 month? You know, do I see people moving in one of these months? There's a whole lot of people. What that might mean is this could be some kind of issue in leasing. And so this is what I call a straw man lease up. If you ever heard the term straw man, basically it means like scarecrow, something like that, someone that stands in for someone else. And so when I see a landlord that has a bunch of occupancy all at one time, a concentration in one, maybe 2 different months, that concerns me that perhaps earlier to this point, that property didn't operate very well. The occupancy wasn't very high at a normal basis. And the seller has decided now, hey, I'm ready to sell that property. Gosh, we don't have very good occupancy. This is not going to be easy to sell. And the seller just opens up the door, leases the property to whomever she can get in the door. And now you may have a property full of a bunch of unqualified tenants. And so what that's going to do is that's going to cause that occupancy to jump up. It's going to run for maybe 90 days, maybe a few months, and then it's going to drop right back down. And by the way, this is going to be the downside. That's going to be right after you bought the property. I've had that happen to me, so I've kind of learned to pay attention to this. So if you see a big concentration of move-in, again, it's not a deal breaker, and it's not necessarily saying that the seller is doing something fraudulent. It's just a thing that we need to notice and say, hey, something occurred here. There was a concentration of move-ins. Okay, why? What happened? We'll now go ask the realtor, we'll go ask the property manager, but we're going to earmark that, and we're going to kind of research that one later on just to make sure that it wasn't some kind of big lease up just to fill the property full of tenants, just to be able to sell it. All right, the rent column, this is just sort of pretty self-explanatory. That should be per unit. That's going to be what each unit is paying for in rent. You may see 2 columns in here. I didn't put them both. One may be actual or current rent. You may see another column that says market rent. And the rent column here, this is going to be the effective rent. This is going to be what's actually on the lease. If you see a column that says market rent, it's always going to be a little bit higher. That is what the owner is suggesting that the rents could be moved up to, right? So that's just kind of what you'll see there. She may say rent, market rent, but that's what we're looking for there, just kind of checking to see where the rents are. This is where we would go back to that comparable rent data from the OM and kind of look around, research our market, and see if maybe the rents are below market and there might be value add in there for raising the rents. Okay, next we're going to look at the unit information. This is going to be whether it's a 2-bedroom, 1-bath, garden style, whatever, 3-bedroom, 1-bath. It's just going to kind of tell you the breakdown of the floor plan of the units. That's all we're really looking for here. And then your tenant information. This is going to be, name typically, and maybe unit number, something like that over here. So that's all we've got there. These are the basic items that you're going to see on a rent roll. Most importantly, we're focusing on the tenant balance side over here, right? Then we're focusing on the move in and the move out, and that's about it. Now, as far as paying the rent, unit information, and tenant info, that's fine. But it's not the big deal. The big deal is going to be right here in tenant balance, move in, move out. All right. So that's what I want you to pay attention to when you're analyzing your rent rolls. And again, this will take you 2 minutes to read, a minute. You just open the thing up. You're going through the tenant balance. Do I see them? Are they there or not? Anybody moving in? Anybody moving out? What have we got going on? How's the rent look? Above or below market? What's going on here? And then our unit info and tenant information at the end. The only other thing that I could tell you on the move-in stuff here, look for what we call legacy tenants. Legacy tenants, right? That means anybody that has been here for more than about 2 years. If you see a lot of tenants that have been living in here for more than 2 years, we call those legacy tenants. That could be good in several different manners. One, that says, hey, the property's stable. The tenants are happy. It's obviously been managed well. It's obviously a good place. These people like living here. They don't move. So that's positive. The other thing you want to look for is these legacy tenants are probably the ones that actually have the lowest rent, right? They're going to be the ones that are below market and that you might actually be able to raise. So that's just something else you really want to kind of pay attention to with your rent roll as you're first looking at it. So, all right, moving on from the rent roll. Now let's talk about the trailing 12, the profit and loss that is broken down into this month-to-month format. That's called the trailing 12, and that's what we're really after. All right, I've kind of broken a T12 down into categories. This is really more just for your reference, and I'll kind of walk through each one of these terms and give you a definition for each one, just so you have a general understanding of what we're looking at on a T12. Yeah, all right, so let me do that. So first, when we first look at a profit and loss, you open the books from the sellers, we have to ask ourselves, are we looking at cash or accrual bookkeeping? Okay, that's the first thing that we want to look at. If we are looking at cash, that is, and it is probably do you some good to kind of Google these terms and look those up on yourself. This is not a complete accounting course. I'm going to give you kind of the crash course on the terms there, but it is something worth knowing a little further. Not how to keep the accounting or not how to do accounting, just how to know when we're looking at one set of books or the other. All right. So when we are looking at cash books is going to be something a little closer to like a checking account. Okay. So in cash books, it's whenever money is collected, it's recorded. If it is not collected, it is not recorded. Okay. So in a cash set of books, T12, your top line is probably going to be something like income or revenue or rent. And it's just going to be a number that goes all the way across. And then you are not going to have vacancy. You are not going to see loss to lease. You are not going to see some of the other items that we see in an accrual set of books. All right. So cash is going to be, if you collected the rent, you have it there on the T12. If you do not collect the rent, you don't have it. Meaning, again, you're not going to see vacancy. Why? Because it's already included. Remember, if that unit was empty and they did not collect cash from that unit, they did not record that cash. So whenever looking at a cash set of books, the first thing you'll probably notice is there's no vacancy. And then there's not going to be loss to lease and some of these other things. I'll explain those. But that's it. That's the main thing. You'll see the income running across the top. You're not going to see vacancy. You're not going to see these things. The reason that it's super important that we pay attention to whether we're looking at cash or accrual is because you can misanalyze a cash deal. If you open a deal analysis template, let's say, and you're now looking at a set of cash books, and on that template, there's a spot for vacancy, and maybe there's a spot for uncollected rent and things like that, and you look at the cash books and you say, gosh, there's no vacancy here. The seller must have not put in vacancy. Well, let me estimate some vacancy. Let me go ahead and put in 10% for vacancy. Well, see, now that's wrong because this already had vacancy included. Now you've added extra vacancy because remember if they didn't collect, if the unit wasn't occupied, they didn't collect any money, they didn't write it down. So now you're doubling up the vacancy or adding artificial vacancy, and that can crush a deal unnecessarily, right? So that's the main point in understanding cash and accrual is that when you're looking at cash, you don't let the template do the analysis for you. You don't have to put in data if that data is not there to put in, all right? Accrual, that is more of the higher level accounting, okay? Accrual is getting into accounts receivable, accounts payable, who owes us money, who do we owe, all this kind of stuff, all right? So accrual, now I'm gonna kind of start walking you through this because the rest of these terms here are basically accrual terms. An accrual set of books is going to start off with gross scheduled rent, all right? That's gonna be your top number. In cash, that top number on the T12 is probably gonna be, rent, income, revenue, something like that. Accrual, it's going to be gross scheduled rent. All right, gross scheduled rent means our property is occupied 100% of the year at full occupancy, at full market rent. So it's occupied 100% of the year at market rent, right? Full top amount that this property could make. We know that that's not really true, right? So that we now need to fix that. So we start off with gross scheduled rent. That's the tippy top number that we can make. Let me back up here. In accrual, we do not subtract things, we add negatives, okay? So in cash, again, if you didn't collect money, you would subtract that and the top line is just the amount that collected, right? In gross scheduled rents, it's a made up number that we now have to add negatives to bring that back down to what is actually in the bank account, which would be the same number as our cash number. All right, I'll explain that a little more. So just keep in mind that whether we're looking at a cash set of books or an accrual set of books, we wind up at the end of it at the same number, which would be the same number on the cash books. But in accrual, we have more reporting. We see more things available to us, such as vacancy, loss to lease, all these other things. So starting over, accrual starts off with gross scheduled rent, 100% occupied 100% of the year at full market rent. But we know we were not at market rent 100% of the year, right? Market rent is what the seller, careful, what the seller believes the market rent should be. Okay, so we have to kind of take that with a grain of salt. So what you're gonna see is that gross scheduled rent, and then the next line down, you're probably gonna see market rent, all right? And that's, or loss to lease. The difference between market rent and effective rent is loss to lease, okay? Market rent being what we believe the market says the rent is. Effective rent here, effective rent is what's actually on the lease, what you're actually collecting, right? So the difference between market rent and effective rent is called loss to lease, okay? So if we started off with our books and they were 100% occupied 100% of the year at market rent, and now we add the negative category of loss to lease that subtracts that market rent problem. Okay, great. Now we've taken care of that. We also know that we were not 100% occupied 100% of the year. We had some vacancies. So now you will see vacancy. Remember, vacancy is a negative number by default. So what we're doing is we're starting off with this accrual number, gross scheduled rents, and adding the negatives to subtract back down to our effective revenue, or the same thing as the cash books. Okay, so the difference between effective rent, market rent, that's loss to lease. That's basically saying we have this much upside in rent growth, allegedly, be careful. All right, vacancy is how many units we did not collect rent on. Now remember, this is always gonna be in a dollar amount. Okay, so vacancy, we're subtracting that. If you had anything else in here, if you had concessions, if you had bad debt, anything like that, you're also now going to subtract those. Concessions, that's anything that we had to give away. 1 month free rent, $100 off the rent, whatever you had to give away to get people to move in, that's called concessions. That lowers our economic occupancy, right? Bad debt, that would be anything that we had to write off. Maybe a tenant skipped out and didn't pay the rent. Maybe we evicted someone, whatever the case. That's another negative number there. Then we get down and you're gonna add other income, all right? So this is gonna be putting in money from vending, other different ways the property may make money, laundry, vending, things of that nature, right? And then that gives us our effective income, all right? So starting over, we gotta figure out, are we looking at cash or accrual? If it's cash, it's pretty easy. If we're looking at accrual, we start off with gross scheduled rent, and then we realize that, the difference between market rent and loss to lease there, we gotta subtract that. We add in loss to lease. We add in our vacancy. That gives us effective rent. We then subtract our concessions. We subtract our bad debt. We add back other income, and that ultimately gives us effective income. And by the way, that is a cash number, all right? So you can see in a cash set of books, we just start off with money, and you don't see any of these other items, as I said. So this is a more simple form of bookkeeping, but we lose all of that data. We lose all this vacancy and all these things. And as I said, if you get this in a month-to-month format, what we're looking at now, and I'll show you in a second, is what is that vacancy doing over time? Is it rising? Is it falling? What's the bad debt doing? Are these tenants paying or not paying? Concessions. Are you giving away more and more and more every month? If the answer is yes, that means your rent is too high and the market is softening. So these are things that we all want to track, and we want to track them in that trend pattern across the month-to-month format of a profit and loss, or T12. All right, so that's kind of looking at the difference between cash and accrual. Really, again, you don't have to know how to keep the books. You just have to know when you're looking at one or the other so that you enter the data correctly into a template. If you are using a deal analysis template, you're analyzing cash books, remember, you're not going to enter in any of this data. You're just going to put in the income, and then you're going to drop down there, put in the other income, and then you're going to go straight into your expenses. That's cash books. Accrual, you're starting off with these accounting concepts, and you're accounting and subtracting right back down to the same number as we had on our cash books there. All right, so let's go back over here and looking at the trailing 12. All right, so first step, read it, then analyze it. All right, and I said that a minute ago. I'm going to read the rent roll, just read it. Then I am going to read the T12, not breaking out a template or a calculator or any of that kind of stuff. I'm just looking at the trends. What's going on? Is it going up? Is it going down? Do I see anything weird? What's going on? Are there any pops in the data? Hey, how about those utilities? Is the water going up? Is the water going down? What's going on there? So I'm just reading the T12 for a general feel. And then I'm going to pay most attention to the T3. Okay, this is the last 3 months of a profit and loss, or a trailing 12 more correctly. All right, the T3, as opposed to all 12 months, is where we get hypersensitive, because this is where lenders look the most when analyzing the deal for your loan. So when you bring this profit and loss, this trailing 12 into your lender, and you say, hey, lender, I'm interested in getting a loan on this property, they're going to look heavily at that T3, and they're going to see what the trend is doing. And if the trend is going up, so let's say the revenue is trending upwards, something like this, then you're going to have a lot easier time getting a mortgage. If the T3 is trending down, and that's kind of your trend there, this is going to be a difficult deal to get done, because your rents are now in free fall, right? They're starting to slowly climb. And if the T12 ends here, and all we see are the numbers are steadily going down month over month, or this is even a T6 or T12 or anything of that nature, if that revenue is declining at the end of it, you're going to have a hard time getting a loan. Because remember, as we talked about in the other video, it's based on the debt service coverage ratio. And that typically is going to be about a 1.2 to 1.25. So if the income is steadily falling, so is the loan to value from the bank, right? Because think about that. You've got to maintain a 1.2 minimum to 1.25 debt service coverage ratio. And if the revenue is falling and we have to maintain a 1.2, then the only other thing falling right along with it is the amount of money we can borrow. So if you see a T3 that is falling, chances are you're going to be putting down more and more and more and more money for that property. And that can make, predicting a loan, especially if you're trying to syndicate, you're trying to raise money, you can't really tell how much money you're going to need. That can just make a deal quite difficult. So that's why I'm really kind of sensitive to the T3 here, the last 3 months of a profit and loss. If they are in decline, I might not be analyzing that deal much further than that, or I would maybe just sit tight on it and see if they can kind of bring the revenue back up before I, at least before I go putting earnest money non-refundable. All right, it's all fun and games until you go spending money. So as long as I can look at the deal and I'm not spending earnest money or putting anything at risk, okay, fine. But if I've got to start spending money, letting earnest money go non-refundable, and this T3 is declining, that's a deal I'm probably going to back away from. Okay, so this is a mock-up of a T12 here, kind of just not a real one, obviously, but this is a general breakdown, and so you can kind of see it's in a month-to-month format, as we talked about. You're going to have this column over here. This is going to be your total column, right? That's going to be totals of all of these things here. So typically, a T12 breaks down, a profit and loss always breaks down into the same format. You're going to start off with the upper half of this profit and loss being your income category. Your second half is going to be your expenses. And remember, from the basic underwriting video, income minus expenses equals net operating income. It is the net operating income that we care about. So when you're looking at the T12, you're really not going to pay much attention to any of the data below the NOI. What you will see below the net operating income can be things like capital expense, the seller's mortgage payment, things like that. We don't care about all that because that's specific to the seller. We are going to re-estimate the mortgage and re-estimate CapEx and things like that in our own analysis. But as far as analyzing the deal, your analysis stops with the NOI, the seller's NOI, and that's all we're after, all right? When we are talking about cash and accrual, that is only up here in the income category. Expenses don't really have anything to do with cash and accrual. So that's why I only kind of mentioned it from the income side. So when you first open a set of books, do we see gross scheduled rent, vacancy, loss to lease, concessions, bad debt, accrual? Do we see rent? And that number, says rent here, income, and it just, steadily across the board, all the way across like that, and no vacancies, none of this other stuff like that. That's obviously cash books. And again, that's just kind of paying attention to both of those so that we don't enter in the data incorrectly. All right, big paid attention here, big concept I've already mentioned. What I start off with when I first open a profit and loss is I look at the first month on the T12 and this one here, and then I look at the last month on the T12. So it does not necessarily have to be January through December, and it more likely will not be January through December. So what I'm looking at is where did we start off at? What was the number here? And then what was the number here? And did it go up or down? So what do we start the year at? What do we end the year at? And is that a trend upwards or a trend down, or what's going on, right? That's what I'm looking at. Same thing with expenses. I want to look at the beginning of the year. Where did we start? And where do we end up with at the end of the year? You know, hopefully in the expenses, this would be like a positive here, and then you actually went negative over here. They went down. Revenue went up. Expenses went down. That would be ideal, right? And then we would, again, looking at the NOI at the beginning of the year, at the end of the year, and what was the delta? Did it go up or down? What was the trend? So that's kind of a quick thing that I read there. Now I'm looking at that general trend across the T12 here. Is the revenue steadily going up? You know, did the revenue steadily start off great? You know, and it's going good, and then it kind of started drifting up a little. Nope, then it started going down, and now you have a falling T3, right? Remember, this is our T3 here, the last 3 months of the T12. And that's where I said, if you see that revenue kind of starting to decline along that T3, you're going to have a little bit of trouble with your lender. So that's kind of patterns that we're looking for in the revenue. All right. And then the expenses, exact same concept. Did I see the expenses, you know, coming along and then they're just steadily on the rise? What's going on? You know, maybe they started off high, you know, and then all of a sudden they got themselves under control and now the expenses are lower. Great. You know, you're just kind of paying attention to that general pattern to find out what's going on. Start the year, end of the year. In the expense category specifically, what I'm really looking for in here are two different categories. I break expenses down in my mind into two major categories. One is going to be general repair and maintenance type expenses, and the other is going to be utilities, because those are the two areas you see the biggest trend patterns. All right, so what I'm looking for, let's start off with just talking about repair and maintenance category. And that's going to be a lot of different items. But what I'm looking for is to see if there was any one month that has a big pop in the numbers. So let's say, you know, you're looking along here and this is maybe, you know, 500 this month, and, you know, this month is 1,000, and this month was 1,500, and this is 300, and this month was 20,000, you know, and this month was 500, and this month was 300, and this month was 500, right? This would be like, wait, what happened right here in this month? This is a huge outlier in the numbers. You know, we were pretty good, and then all of a sudden, bam, something happened. Okay, that tells me right there in the repair and maintenance category that what we might be looking at is a seller who has put capital expense items above the line. All right, now keep in mind, when we say the line, we mean right here, the NOI. So that's called the line in the books. And so above the line is anything up here, below the line is anything down here. So CapEx, capital expense items, are not an operating expense. They go below the line, below the NOI, okay? So if you see that big giant pop in the numbers one month, that's an indication that maybe that seller went and did some roofs, replaced a bunch of HVAC, you know, redid the parking lot, some kind of one-time big expense item that really shouldn't be there. And what that's doing is that's lowering the NOI all the way over here. It's causing that NOI to drop heavily in that particular month, which then averages the whole thing down. Yeah, but this isn't a real expense. That shouldn't be there. So what you want to do if you see that is first call the realtor, you know, maybe talk to the property manager, or if you go do a property tour, ask about that number. If you find out that that is CapEx, then you want to credit that back to the NOI and reanalyze the deal, right? Put this expense back because it shouldn't be there. It's just bad bookkeeping, okay? So that's what we're looking for, and that's why I'm kind of looking for those trends. Do I see any kind of big jump in the numbers that tells me, hey, something's going on there? And again, this is reading the T12. I've not broken out a calculator or a template or anything. I'm just reading the data, all right? The second category, the utilities category, same concept, except a little bit different. What I'm looking for here, again, is trend pattern, But there are three different trends I'm looking for here. One trend would be, and this is only in the like utilities, largely water. You know, electricity is usually paid for by the tenants. Water is usually paid for by the landowner or the landlord. And so that's what I'm kind of looking for largely is water. And I'm trying to figure out, are there plumbing leaks? Are there things here that might be going on this property? So if I see the water bill slowly and steadily rising each month, and it's just a slow trend upwards, what that is very likely to be is just lots of little tiny pinhole leaks. It's called pinhole leaking. And that's probably due to something like supply copper lines. And what's going on is you've got just lots of little tiny leaks all over the property, and there's no one major leak, so it's not something you can just go and fix, and there it is, stop the leak. It's just like your plumbing is turning into a sieve, right? And it's just leaking little bits everywhere. That's not good. That's probably not value add, because what that probably means is you're going to wind up replacing a lot of plumbing on that property. So that's not necessarily a positive thing. If I see this trend in the water, I may then really be budgeting for a lot more capital expense on this property just to stay safe. Okay, that's trend number one. Trend number two would be a major leak. And we have two types of major leaks that we can see in the data. Number one would be, you know, your numbers are running along like this, they're running along, all of a sudden, boom, they jump up like this, and then they come back down and they cruise along, right? And this, again, this is like the water bill each month. So it's normal, it's normal, it's normal. Boom, it's super high. Boom, it goes back down. This is what a major leak fixed looks like mathematically on the T12, right? You're seeing their water bill, all of a sudden, boom, it blows up, and then it goes back down. They fixed the leak. They had a big leak, and it's usually in the summer. Usually going to be one of these months right here. And you'll see that big spike, and then if it goes back down here like that, they fixed it. Okay, so that's not value add, but that is an indication that maybe we've got some plumbing issues. We've already had one, they fixed it. I would want to ask about that, right? Here's another thing, and this is where there might be value add. You see the numbers in the water bill run along, pops up, keeps running along, never goes back down. This is a major leak not fixed. And this could be value add here, because if you can go and identify where that leak is and correct it, you may then be able to bring that utility bill back down, and the difference between, you know, where it should be and where it is today could be profit or could be value add. So that may be something that you can fix. So something we're looking for there. It's just trends. It's just kind of reading the data and watching. Do we see it steadily rising up? Do we see it jump up, go back down? Do we see it jump up, stay up? Or is it just running flat all the way across? Whoops. So ideally, we would want to see it just running flat, you know, all the way across. That means that everything's stable. Okay. So that's kind of looking at the T12. That's kind of reading that T12 again. Same thing with the NOI. Did it go up over the year? Did it go down over the year? What's going on? You know, and then we're looking heavily at the T3. That's the big area. Are we seeing positive trends upward? Are we seeing trends downward? And what is our NOI doing? Those are the major points you want to kind of pay attention to when analyzing a T12. All right. So this is where we're going to be getting these from the realtor. Going to be getting these, again, as I said before, don't analyze a deal from the property package. Make sure that you get this directly from the property manager, directly from the seller, something like that, and typically in an Excel or some sort of database format is ideal. So let's talk about for a minute the T12 versus pro forma. All right, the T12, when we first analyze a deal, when we first sit down and say, all right, is this a good deal or not? We have got to analyze the seller's data exactly as it comes in from the seller, right? We've got to analyze the T12 exactly as it comes in, because the seller's information, the T12, is what that property is going to do financially the day of closing. Not 1 year or 2 year or after we raise the rent and all this pro forma stuff. Nope, that's pro forma. So step number one, we've got to kind of do a cash flow analysis. You take the T12, you don't change anything, enter the data in, and let's see what we got. So what I'm saying is start off with the asking price, all right? Start off with the, from the T12, and you're analyzing a deal, we start off with the ask price, not what we think the property's worth or what you should pay or anything, not that. You're going to put in the asking price. Then you're going to go to the profit and loss and you're going to put in the income, okay? And then you're going to go to the profit and loss and you're going to get just the expenses. You're going to put in the expenses and that's it. Don't change anything, all right? That then gives us our NOI, all right? Now that we have the NOI, the seller's NOI, and the seller's asking price, what we have to do is come over here and now put in our mortgage information, all right? Mortgage. We're going to put in our mortgage information over here, which is going to be your percent down, the interest rate, the amortization. You're going to have to kind of estimate what you think this is going to be. You want to pay attention to the market on a regular basis, talk to your lenders so that you know what a good mortgage rate is. But you're going to put in your mortgage info and a little bit of closing costs. All right, closing costs. All right, now what we're looking for, I'm going to erase this, what we're trying to calculate quickly from that is the debt service coverage ratio and the cap rate. All right, cap rate. Now we talked about that in the first video, how to analyze this and how to calculate these, so I'm not going to go over that again. But remember, as I've said, we want to see about a 1.2 to 1.25 debt service ratio on that income. So that's what I'm trying to figure out. I'm going to plug in that T12 data, not change anything, and see what my cap rate and my debt service ratio looks like, because that shows me right there how much I can borrow against that property. So if I plug in all the information and I see that the seller's price and the seller's net operating income are giving me a number less than 1.2 or 1.25 if I'm going to an agency loan, then I know I can't borrow that mortgage that I put in over here. So if I see that a property is less than 1.2, there are only two things I can do: pay less or borrow less. That's it, all right? So what I recommend that you do, again, we're putting in our income, expenses, the mortgage info, we get a debt service ratio of less than 1.2. What I recommend you do is now come over and start lowering your loan to value, whatever you estimated in your mortgage calculator there. You probably put in, let's say, 80% loan to value because you want to put a 20% down payment. And you put in 20% down payment and it gives you a low debt service ratio. All right, what that tells you right there is you can't borrow 80% on that property, not with that price or not with that NOI. So what I recommend you do, start lowering the down payment. So let's try 25%. What does that come to? 30, 35, 40. More down payment brings the debt service ratio up. Okay, so what you've done there is you figured out about where you can borrow if you leave that price where it is, all right? That's showing you ultimately what your loan to value is going to be and how much down payment you're going to have. Okay, so now let's go the opposite direction. Let's move the mortgage payment back to where it was. Let's move the mortgage leverage back. Let's put it back at, say, 80%. Okay, now you come over to the price and you start lowering the price until that debt service ratio comes up to a 1.2 or 1.25, right? And so now we see those are the two outliers, the two extremes. We can either lower the price considerably or we can put down more money. One of the two of those brings the debt service ratio up. And what you want to do is probably come to a combination of the two. You're going to try and get a little off the price and you're trying to put down a little more, and that brings that debt service ratio up. That's kind of how we can start to figure out what a reasonable price for something is and why we analyze that T12. Okay, if you do not know the price, we can use the cap rate to back into that. So all you have to do is put in your income, your expenses, estimate your mortgage payment, and put the closing costs in. Stop. All right, now you've got to know what is the cap rate in the market for that kind of property. Is it an A, a B, a C, whatever it is? You need to know what the general cap rate in that market is. And now you just plug in a purchase price until the cap rate comes in line, at the bottom of your template or wherever it is, or cap rate. So, if I'm trying to get a price that gives me, let's say, a 5 cap rate, and I plug in, the purchase price or what I believe the purchase price is, and it gives me a 2 cap rate, okay, then that's too high a price. I need to lower that price some, and lower the price, cap rate comes up. Whenever I get that cap rate to come up to the 5 or whatever I wanted it to come up to, then that is roughly the value of that property based on cap rate. It does not mean that that is the sale price or that's what the seller will accept. I'm not saying that. I'm just saying that's what you should pay based on cap rate. And that's kind of how we can use cap rate. You'll need to look the formula up. That's in the other video. So just use the formula, reverse in, we create our price using cap rates. So those are kind of different ways of looking at a deal. And that's why we start off with the T12. That's telling us exactly what the property is going to do the day we close, right? It's also going to tell us what kind of mortgage we get. And that's why I say it's super important that you don't mess around with the T12. This is not the analysis where you want to start saying, yeah, but the rents are below market and we could raise the rents. And that expense is a little high, so I think we could cut that expense. We could do this, we could do that. Now you're creating a pro forma. That's fine, but you have to have two completely separate analysis, right? T12, what's the thing doing day of? And then pro forma, what could the property do someday in the future, right? The reason that we have to be super careful while analyzing the T12 is because that tells us what kind of mortgage are we going to get, what kind of mortgage we can get. And that allows us to take possession of the property so that we can come in and enact our pro forma, raise the rents, cut the expenses, do whatever the case, right? And so in a lot of cases, when we see the T12 gives us a price that won't allow us to go get traditional financing, the debt service ratio is too low, that's when you start using creative financing. That's when you come back over here and use master lease options, seller financing, things like that, right? And that's in the other video as well. So that's kind of a breakdown of T12 and why we do that. All right, we've done the first analysis. We know what the debt service ratio is. We know what the property looks like per the seller's numbers. Okay, great. Now we can come over separately and create a pro forma, all right? You don't want to commingle this data because that's what I call financial spaghetti. If you go commingling all this stuff, it's like spaghetti. You just can't tell which way is going, which is the beginning, which is the end, and it's just a big pile of numbers going everywhere. And now you wind up analyzing a pro forma. That's not a good idea, right? We can create a pro forma, just don't analyze a pro forma. So pro forma means the future projection of the deal. What is the deal going to do? This is what the deal is doing currently. This is what we think the deal could do. Let's say the rents are below market and we want to raise the rents. Let's say there's some expenses we want to cut. Fine. So now what you would do for the pro forma is you leave the purchase price. You can open a new template or a new deal analysis, whatever the case. Right? We're going to leave the purchase price in there, the same as we have here from the seller. But now we can increase the revenue, we can decrease the expenses, and we can kind of play around with some of those numbers to say, what if? What if I could get a hold of the property at that price and I could do these things? Is it a good deal then? And if you find out that this side, when we do this analysis, the deal is not a great deal or the numbers don't work, but then you find if we do this pro forma, all of a sudden the numbers work out pretty well, then our challenge really is just taking possession of the property, getting a loan, taking it over somehow, and that's where we can use creative financing and other things to be able to get a hold of a property and then be able to put in our pro forma, do whatever it was the seller couldn't do, didn't do, right? But the pro forma is where you have to be careful, and that's where I say don't pencil whip a deal, because kind of going from a deal that doesn't look good on paper over here to all of a sudden a deal that's a great deal on paper, be careful. Make sure what you've done is reality. Make sure what you've done, the deal will actually work and you can actually get that pro forma going, and that you have given yourself the time frame to be able to do it. Those are key points. All right. So, you ever heard the comment, never buy on pro forma? We hear that comment all the time, never buy on pro forma. I think that is an incorrect statement. What we want to add in here, you buy on pro forma all the time. Let me be clear. What this statement should read, and I'm here to correct the world going forward and go tell everybody, never buy on the realtor's pro forma. So let's add the realtor's pro forma. Never buy on the realtor's pro forma. When we sit down and say, well, we could raise the rents, we could cut this, we could do that, and we estimate anything about a property, you just created a pro forma. So we buy on our pro forma almost every time. We should never buy on the realtor's pro forma. So that's where I kind of say this is a sentence that I think is a little overstated and misunderstood. It's okay to buy a property on your own projections. If you say, hey, we're gonna do this, we're gonna do that. What do you think value add is? Value add, renovations, that's all pro forma. That's all projecting the future value of the property due to the future operations, pro forma. You just don't want to do it from what the realtor says. Again, if you're a realtor, love you mean it, love all my realtors. I just don't buy properties on your pro formas, only on my own. So there you go. Stay safe with that one, and you'll probably be all right. Just don't buy in the realtor's form. Moving on. So now let's talk about RUBS, Resident Utility Billing Systems. This is one of my favorites, RUBS. And you'll see this spelled RUBS, Resident Utility Billing System. And you'll see that a lot of times. What we're talking about is the difference between master metered and individually metered utilities, okay? Master metering means you have one bill, one meter, and that serves the entire property. So typically speaking, we see properties that are master metered for water. It's one giant water meter, and the landlord pays all the water, and water's free to the tenants. It's just one meter. But we see utilities like electricity and gas tend to be individually metered per apartment. So therefore, the tenants each pay their own electric and gas bill, right? So what a lot of times landlords will do is they will charge the water back to the tenants. And that's called a resident utility billing system. And it's a great idea, but you got to be careful with this one. Just because the landlord is not currently charging back for water doesn't instantly mean that you can charge back for water. All right, because you got to kind of ask yourself, well, what, the landlord didn't think of that? The landlord hates money? You know, it's like, come on. So you've got to kind of figure out, why are they not billing back for water, and is it a possibility? What would make it not a possibility? Competitiveness, right? If no one else in the area is doing it and you start doing it, that may make your property not competitive. Second concept, all you're doing is raising the rent. You know, when you add RUBS into a property, all you are doing is raising the cost of living to be at your property. That's it, right? And I see students come along with us all the time. Hey, we're going to raise the rents $100, and then we're going to bill back $50 for water. Oh, so you're going to raise the rent to $150. No, that's water. That's just, look, the tenants don't care what you call it. They really don't. This is accounting. This is on your side. All they know is their cost of living went up $150. The end. Right? So you have to kind of consider this in your rent growth model. So if you're already maximizing your rents to the market, and then you're going to add water on top of that, you may make living at your property too expensive and therefore not competitive. So it's just something to keep in mind. Just because the landlord's not currently doing RUBS doesn't mean that you get to wave a magic wand and poof, charge back for utilities. Perhaps you can, but you want to do a little more research. This is one that you can kind of pencil whip the deal with, right? So just do your research and make sure that everybody else is doing it. You're not the only one, and that the overall cost of living in that unit or property can sustain that kind of growth. All right, if you do that, you'll be good. That's RUBS. All right, so now last concept, we're going to talk about advanced cap rate here. All right, we've talked about cap rate before. We talked about what cap rate is and how to calculate it. I'm going to show you now a more functional use for cap rate, and a concept that I see a lot of people not really considering. And this is something that is meant to keep you safe. All right, I'm going to show you something here, because there's going to be some downside to what I'm going to show you, and there's going to be some upside. So just keep in mind that what I'm showing you is to keep you safe. All right, cap rate. What we have to consider is buying a property at a low cap rate. All right, that means that we are shoving a lot of the profit over to the seller at closing, and that it is going to take us time to raise the rents and to get the cap rate decompressed before we make money. So the lower the cap rate, the more profit you're kind of giving that seller at closing. All right, that's okay. So what we'll do is let's do this graph here. We'll say let's buy a property at a 4 cap rate. All right, that would probably be a low cap for a lot of properties. Maybe not these days. So we'll say we're starting off with a 4 cap. Okay, what happens over time is if we can raise the revenue like this. So we'll say this top line is rent growth, all right, and that's rent going up, and we can hold the expenses relatively level like this. Then what we have is an increase in the NOI, right? The net operating income. NOI goes up, we make more money. So what is occurring here, because the purchase price is held steady, we only buy the property one time, as we raise rents over the years, the cap rate decompresses as the NOI gets bigger. So keep in mind, we're holding our expenses steady and our revenue is going up. And what that does is decompress the cap rate. So you bought it at a 4 cap, and that 4 cap becomes a 6, and then it becomes an 8, and then it becomes a 10, and then later on it's at 12. And these are the years of you holding it, increasing revenue, keeping your expenses level, NOI is going up, and the cap rate is decompressing, meaning it is getting bigger. So you bought it at a 4 cap, and then let's say this is year 5 up here. So you've held it for 5 years, right? And now you're operating at a 12 cap rate, but the market is still at a 6 cap for sales. So you bought it at a 4, you're selling at a 6, and in theory, that sounds like you're losing money. You're like, wait a minute, how am I buying it at a lower cap rate that I'm selling it for? Well, right, if you bought it at a 4 cap and the next day sold it at a 6 cap, you're right, you would lose money, you would. But if you buy it at a 4 cap and operate it all the way up to a 12 cap and then recompress to a 6, you make a ton of money. Even though you bought it at a 4 and you sold it at a 6, you operated it up, recompressed the sale, made plenty of money. So this is how we functionally use cap rates, okay? This is the good side of the model. But keep in mind, what I'm saying here is that we're keeping our expenses level. Now, what happens if you buy this 4 cap here and your rents go up, right? You're thinking, great, the rents are going up, but guess what? The expenses do too. And the expenses go along with the same pace as your rent growth. Then your 4 cap never decompresses, does it? It's a 4 cap forever. And ladies and gentlemen, that is not a 4 cap, that is a foreclosure. Careful about this one, all right? Why would the expenses rise as rapidly as the rent? So we can have CapEx go right up and expenses go along up with the rent in older properties. I did that again, CapEx. That's what happens in these older assets, right? You're getting the revenue going up and that's fine, but your expenses are kind of going along with the rent, and therefore you never get that yawning of the cap rate. You never get the decompression because your expenses are going right along with the rent, and you have that lockstep. And that's where I say that 4 cap then never decompresses itself, and it stays under glass forever. If you have bought a newer property, that's less likely to occur. And that's why I say newer properties, you're going to see the expenses, you're going to see the revenue go up, at this pace, and you're going to see the expenses kind of slowly going up at this pace, a newer property, and you still get that positive NOI growth in there like that, you know what I mean? But if you're talking about older properties, you may still have rent growth, but you may have that expense growth that kind of goes right along up there with it, something like that, and you just don't really get much profit in there. And this is what we see in these older buildings. So this is where I said the dark side. If you're focusing on older, affordable properties and you're buying them at low cap rates with an unknown amount of CapEx in there, old plumbing, old roofs, old flooring, you might find yourself in trouble, okay? And that's what we call cost basis. And we've talked about this in the other video, cost basis, all right? So you gotta watch your cost basis. Cost basis is what we're purchase price. So purchase price plus costs, all right? And that's gonna be renovation costs, anything that you have to put into the property, CapEx, closing costs, renovation, everything that goes in there. So your total all-in number is your cost basis. You would like this number to be about 80%. So you want your cost basis to be, 80% of the after repair value. So once I've bought the property and once I've fixed it up and once I put all this money into it and I did all these things, and that's my cost basis, everything that I've got in there, I want that to be, the property to be worth about 20 to 30% more than what I've got in there. Because if I do all this just to get the property, equal to what I put in there, I haven't made any money, have I? And there's no point in doing that. And so that's why I'm cautioning everybody about some of these older buildings. It's like you really have to be careful because you're buying them, if you buy them at a low cap rate and you have to do all that repair and maintenance, you might not really get a lot of cash flow. You might not wind up making the money that you think you're gonna make. So I'm gonna leave it on that cautionary tale there. You just kind of have to be careful. You wanna be safe. Don't chase in deals. Don't get into stuff that's too old. And if you're going to do older properties that are value add assets, that's great. Most of the properties I've done in my career were value add. They were some sort of renovation, and I've done a ton of affordable housing in lower income housing. They were great properties, did really well, but I bought them at the right price. And so that's the key. Always pay the right price, because the wrong price is the gift that just keeps on giving. Okay, so that's advanced deal analysis. Go through all this, go back through the first video if you need a refresh on that. The idea is that we get out here, we bring in as much deal flow as we can, we get as good at analyzing deals as we can. Once you know how to analyze a deal, once you understand all these concepts, then it's just about deal flow. Rinse and repeat, and you'll be on your race to 80. We'll see you out there.